Welcome everyone, thanks for joining another chapter of the Financial Independentist. Today we're going to talk a little bit about Celsius. Celsius is a beverage company that markets a portfolio of energy drinks under several brands: Celsius, Alani Nu, and now Rockstar. We'll be talking more about these brands throughout this video. Celsius products are marketed as a healthier, better-for-you alternative to traditional energy drinks like Monster or Red Bull, with ingredients aimed at boosting metabolism and promoting an active lifestyle. The company relies on a third-party network for manufacturing and distribution, with a significant partnership with Pepsi for distribution in the United States, which is their largest market by far. Celsius is currently trading at $14 billion market cap, with a revenue of $1.67 billion for the year, gross margin of 15.5%, and EBITDA of 9.1%, profitable with a net income margin of 7.9%. The stock has been doing well recently since last March when they announced the Alani Nu acquisition. However, we see that the price has gone through a valley from the previous peaks of around $90 per share. That downtrend was caused by Pepsi inventory management concerns, and we will be addressing also that in this video. Celsius has the potential to show triple-digit revenue growth in the next couple of quarters, and has strong catalysts that will materialize thereafter. In addition, Celsius recently has posted an agreement with Pepsi that is very beneficial for the company, both providing additional financing, new asset brands like Rockstar, and overall reducing risk and validating the long-term investment thesis. But before that, let me share a quick reminder that just a few days ago we published a video on how the Federal Reserve interest rate cuts will impact the market, and several companies that will benefit greatly from that. Link in the description below. And by the way, if you like this content, please make sure to hit the like button and subscribe right now. It really helps the channel grow, and you'll even get better content in the future. Please also leave some comments below regarding this topic or how we could improve future content. Feedback will be most welcome. Alright, let's get on to it. Starting with the second quarter 2025 financial results, as we see, the company scored $739 million in revenue, up 84% year-on-year versus $402 million in the same quarter last year. The company also posted all-time record net income of $99.9 million. These results were extremely strong, and the stock price popped up significantly thereafter. The main catalyst for this impressive second quarter 2025 revenue number was the addition of Alani Nu, which contributed $301 million out of the total $739 million revenue. That's about 41% of the total. The rest of the revenue, $438 million, came from the Celsius brand, which if we compare with the same quarter last year, $402 million, we see that it grew high single digit, or 8.9%. So, although the growth in this brand has slowed down significantly, it's not a dead brand, as many people have been saying. And as we'll see later in the video, we need to be careful with the growth in this brand, as it may face severe distortion caused by Pepsi inventory management. With respect to Alani Nu, it grew an outstanding 129% year-on-year. If we analyze their contribution from this quarter, $301 million, it comes up to $1.2 billion revenue in the year. This strongly reinforces the acquisition thesis. As a quick reminder, Celsius acquired Alani earlier this year for a total of $1.8 billion. So essentially, $1.2 billion revenue divided by $1.8 billion purchase gives us a 1.5 price-to-sales ratio, which is ultra cheap, even more so when we consider the quality of the brand, the market it serves, and its growth. This is a very good indicator of the capabilities of the management running the company, and in particular of John Fidley, the CEO. Amazing job there. As we see in the bar chart, in 2024, especially during the previous three quarters, September, December, and March, the company was beaten down severely. Revenue was down double-digit, and the narrative was horrendous. This dropped the stock price to well under $30 per share, and even below $25 per share for a few weeks. The reason why all metrics were down was because of Pepsi inventory management. Pepsi controls distribution of almost all Celsius North America retail sales, which is the vast majority of their revenue. So when Pepsi decides to increase their inventory, Celsius revenue will spike, but when Pepsi decides to empty some of their existing volume, then Celsius revenue sharply falls. This is exactly what happened in the previous three quarters. So, effectively, Celsius revenue is not really under their control, and instead, Pepsi has the ability to manipulate it through their own inventory management. Now, looking at the numbers, we see a very pronounced valley in those 3 quarters, making them very weak comparisons against the upcoming 1, 2, or even 3 quarters. In addition, the company remained profitable throughout almost the entire valley, just showing a little net loss in the December quarter, which was quickly recovered. This shows good fundamentals even during challenging times. Moving on, recently, Celsius made public a press release indicating that Pepsi has acquired $585 million of preferred stock, increasing their holdings to 11% of the company. This is dilutive to shareholders, as now there will be more shares split among more investors. But overall, I think it is positive for the company. First, it aligns Pepsi interests with the shareholders, as they now have more skin in the game. So Pepsi will now be more interested in the success of the company. Even if they play with their inventory, they will do so in a way in which they don't kill the company. This is positive because it mitigates risks. Second, Celsius has now $585 million more in their balance sheet, which management can use to fund their next growth project, either organically or via another acquisition. And as we discussed before, Celsius management is top-notch, so I'm very confident in their ability to use this fund intelligently. Third, and this is also extremely important, Alani Nu will now start benefiting from Pepsi distribution chain, further exploiting the synergy they have with Celsius' core brand and reaching markets they were unable to access before. And finally, as part of the deal, Celsius has also acquired Rockstar Energy, which is a very interesting and cheap acquisition that has a lot of synergy with the other two brands. While Celsius targets the more health-oriented sector of the population, gender neutral, and Alani Nu targets the young female market, Rockstar will mainly target the young male market, providing the company a holistic approach. In other words, brands are not expected to cannibalize each other. Now, looking into the balance sheet, we see that the company has $615 million in cash and cash equivalents, which in addition to the $585 million it got from the Pepsi deal, the company now has about $1.2 billion in cash and cash equivalents. This, compared with the $863 million they have in debt, which is a result of the Alani Nu acquisition, puts the company in a very strong financial position, with plenty of cash for the management to deploy, as we discussed previously. A metric we need to keep monitoring are the inventories, which have increased from $131 million to $230 million. But we need to keep in mind that in this last quarter, Alani has been added recently to the company and has just been integrated into the balance sheet. So we should expect to see the addition of both Celsius and Alani Nu inventories in this number. From that perspective, I don't think that's a big deal to see an increment from $131 million to $230 million. Although in consecutive quarters, we should keep monitoring this number to ensure it remains under control. Now, looking into the energy drink market in the United States, in this slide from Celsius Q2 2025 earnings, we see the different market shares for Celsius' portfolio of brands. Here, they are highlighting their portfolio with a 17.3% market share, comprising of 11% from Celsius and a 6.3% from Alani Nu. In addition to this, now we have to start considering Rockstar Energy with a 2.4% market share, for a total of 19.7% market share. This is a very important number because now they are close to 20%, whereas Monster is only 26.8%. So Celsius is not that far from Monster, considering that the overall growth for the Celsius portfolio is larger than Monster, both in absolute and relative numbers, which is very relevant as Monster is a much larger company than Celsius. It's important to note that most of Celsius' growth comes from Alani, which as we discussed is growing triple digit. On the other hand, Celsius is also growing, although much slower. We saw last quarter growth was about 8.9% year on year, but I think they can make low two-digit growth in upcoming quarters. We also see that Rockstar is currently losing market share, so this is something management needs to start looking into and hopefully they can turn this around. We will keep monitoring Rockstar market share in the next quarters. Now, if we look into some high-level numbers between Celsius and Monster, we see that Celsius' current market cap is $14.1 billion versus Monster market cap at $62.6 billion. So that's about a 4x difference between Celsius and Monster. If we look into the market share, Celsius currently has 19.7%, comprising of 11% Celsius, 6.3% Alani Nu, 2.4% Rockstar, while the combination of all the Monster brands is 34.6%, comprising of Monster 26.8%, Reign 2.4%, NOS 2%, and Bang 1.4%. And they have some other minor brands like Full Throttle, Relentless, and Burn, which we can estimate as a 2% combined for both. So we see here that between Celsius and Monster market share is about a 60 to 70% difference, right? While the valuation is 4x difference. So that's a very important data point. Now, if we look into the TTM retail sales, for Celsius we see $4.75 billion, while for Monster it's at $7.66 billion. So again, we see around 60 to 70% difference between one and the other, which kind of maps to what we saw in market share. So there is no significant divergence between share and sales. If we put everything together, that along with the difference in valuation, we see that the price to sales for Celsius is 3x, while the price to sales for Monster is 8.2x. So that's more than 2.5 times more expensive than Celsius. And as we saw before, Celsius is growing faster than Monster. Okay, so if we look into the numbers from last year, Q3 2024, we see that the revenue number was very weak. They scored only $265 million revenue for the entire quarter. This was down 31% year on year because the company was under strong pressure due to Pepsi's decision to empty some of their inventory. As we see, if Celsius is to double this revenue value in the upcoming quarter earnings report, it will need to achieve at least $530 million in revenue. We already saw that Celsius scored $739 million in Q2, so in my opinion, the company is very well positioned to beat this $530 million revenue this upcoming quarter. Keep in mind that I'm not saying Celsius is going to have a quarter-over-quarter revenue growth. That will be above $730 million in the quarter, which they may, but it's not guaranteed. We shall see, although I think it's doable. On top of that, Celsius now owns Rockstar in its portfolio, although I think it's still too early to count any revenue from it. The way I see it, Rockstar will start contributing to Celsius revenue by Q4 this year. All in all, it's a no-brainer that we're gonna see a triple-digit revenue growth in the upcoming quarter. Now, how the market is going to take this is yet to be seen, but it's quite likely that the company is going to pop after earnings if the numbers are in this line. In the end, the comparable is very weak, so if Celsius destroys last quarter earnings, it will be sending a very strong signal to the market, and I think it will be received very positively. Looking ahead into Q4 2024, we see that the revenue was $332 million, so following a similar reasoning, to double this revenue, we'll be talking about $665 million, which while it's substantially more than $530 million from the previous quarter, it's also a very achievable value, more so considering that Rockstar will be contributing to it. So we can be looking into 1, 2, or maybe 3 consecutive triple-digit revenue growth quarters. I think this momentum is going to make the stock pop quite a bit, but we shall see. So, what's my game plan for Celsius? Well, as a full disclosure, currently the Independence Fund owns approximately a 2% in Celsius stock, at an average price of $35.18 per share. So we're about 50% up at the current valuation. We had a very good rally after the Laninu acquisition and the subsequent Q2 earnings release. However, in the last few weeks the company has been losing some steam, as we see in the chart. Given the analysis so far, I don't see any reason to sell any shares at least until after 1 or 2 quarters at the very least. Afterwards, we will continue monitoring how the company performs, and that will determine future action. But at this point, I see a path for us to keep holding Celsius throughout 2026. So yeah, the current plan is to hold existing position. With respect to adding more shares, we already own a 2% of the fund in Celsius, so probably there's no need to push it anymore, unless we find a good buying opportunity. Say the stock goes under pressure again and we see prices under $40 per share, then yeah, probably will be a good point in which we can start adding a few more shares. If you don't have any position in Celsius and are considering to start a position based on these analysis numbers, first, please do your own assessment. This is not financial advice, but my suggestion is to look for an entry point if you can below $50 per share, which is almost there as of today, so not bad at all to be honest. I think, as I said before, in Q3 and Q4 2025 are going to be very good and the comparable is very weak, so the company is likely going to pop. It might even be a good scenario to buy some calls and play earnings. But you should do what you understand. I'm just showing you the numbers, right? Looking a little bit on the qualitative analysis side, currently we have Celsius rated as a speculative growth B, which is the lowest investment grade a company can have. Why is it so? Well, first because, as we discussed, Celsius is a company that has a slightly manipulated revenue, in the sense that Pepsi controls the vast majority of the inventory that Celsius sells. So essentially it's up to Pepsi to determine if they want to overbuy or underbuy inventory from Celsius. And by doing so, they can manipulate the revenue up or down depending on their desires. So that gives us a little bit of sense of loss of control on what the company can do. Although in the long term, Celsius is going to be doing well as they're building a very solid portfolio, growing the brands, and attacking different markets. But in the short term, we don't have visibility on how the revenue is going to be looking like, and it's not going to be growing up smoothly. There's going to be moments in which it is going to be growing a lot, and moments in which it's going to be dropping quite a bit. So because of that sense of loss of control, added to the fact that the energy drink is a narrow mode type of business, where the main mode is brand, and unless you are Coca-Cola or one of these few big brands, you will have to be competing all the time for the market. So because of all of that, I think speculative growth B is a reasonable rating for Celsius. It's an investment grade you can buy. We have a 2% of the fund on it, but again, you have to take into consideration that this is a speculative position. Alright, that's all for today. Just a quick reminder that this content is not financial advice. Please do let me know in the comment section below if you have Celsius stock or if you have plans to start a position, and don't forget to like and subscribe. It helps us a lot in providing better and better content. Thank you very much for watching. See you all in the next episode.